Good afternoon, everyone. Welcome to the JKH Investor Relations webinar for the fourth quarter and full year ended 2023-24. My name is Gihan Kure. I'm the Deputy Chairperson and Group Finance Director. I am joined today by Krishant Balendra, Chairperson and CEO. The format for today's proceedings will be where Krishant will initially take us through an overview of the key performance highlights and an overview of the macro environment for the fourth quarter and the full year. And thereafter, I will take you through a presentation on the key financial highlights for the fourth quarter as well as the full year. And thereafter, we will break for a Q&A session. If you have any questions, please post them on the Q&A tab at the bottom of your screens. With that, I'd like to hand over proceedings to Krishant. Krishant, if I may ask you to give an overview.
Thank you. Good afternoon, everyone. Thank you for joining our webinar. Just to start with the macro, we continue to see the economy strengthening, a lot of the macro fundamentals improving. Inflation, which as you know, went to levels of around 70% in late 2022, is now at low single digits, and all predictions are that it will continue at those levels. The Sri Lankan rupee, which depreciated to around 370 to the dollar again in late 2022, is today at about 300 rupees to the dollar. Interest rates, which peaked at over 30%, we are now seeing in the last few weeks the one-year treasury bill falling below 10%. So overall, the macro fundamentals have strengthened significantly since the economic issues of 2022. The discussions, the engagement with the IMF continues. We are in an IMF program. There was a staff visit by the IMF in March and a staff-level agreement for the next tranche of the IMF program, and board approval for that is expected in the month of June. Discussions on the debt restructuring are continuing. There has been an agreement with the bilateral creditors and an agreement with the bond holders, with the ISB holders, is expected in the next month or so. And from what we are hearing, the authorities are very confident that there can be an agreement on the overall debt restructuring quite soon. On the privatizations, the government has continued to progress. Some of the privatizations, requests for proposal documents have been issued, and interested parties are in the process of submitting offers for some of the privatizations that are in the pipeline. Electricity tariffs, I'm talking about that because it's quite material for our group, particularly our Cinnamon Hotels business and the supermarkets business. And as we mentioned in our last call, electricity tariffs have come down after a significant hike over the last 2 years. There was an electricity tariff cut of about 15 to 20% in March, which is quite positive for some of our businesses. The increase in VAT that occurred on the 1st of January from 15 to 18%, and the extension of VAT to items that were previously not VATable also from 1st January has had some impact, but the impact on inflation was not as significant as some had expected, and inflation continued to remain below 5 or 6% and is at low single digits at the moment. And looking at some of our businesses, while initially, I think with the concern about the impact of VAT in early January, there was some impact on consumption and in the sales in our supermarkets. From about in January, we have seen a steady improvement in our sales volumes in our soft drinks and ice cream business, and even in our processed meats business. And also we have seen an increase in same-store sales in our supermarkets. Gihan will go into more detail on that during the presentation. Cinnamon Life project, which what was previously known as Cinnamon Life. We did announce 2 weeks back that together now with the partnership with Melco, we will be rebranding the building as City of Dreams Sri Lanka, which is the flagship integrated resort brand of the Melco group. I won't go into too much detail on that. The announcement was made, and Gihan will talk on that during the presentation, and I will be here for any questions. The opening of the Cinnamon Life Hotel within the complex, which will have 687 rooms, is expected in August this year, with the casino and the shopping mall expected around mid-calendar year 2025. The Western Container Terminal project construction is very much on track, and we expect phase 1, which will be about half the capacity. We are about capacity of about 1.6 million TEUs will be operational very early in calendar year 2025. So with that, I will hand over to Gihan for the presentation on the quarterly and annual performance, and we will both be here for questions after that.
Thank you very much, Krishan. So I'll take you through the key financial highlights for the fourth quarter as well as the annual performance. Starting off with the fourth quarter, as Krishan mentioned, we've had a strong fourth quarter with a 20% growth in EBITDA. And as you can see on the table, it's come across from a lot of our businesses. And as we go through the rest of the slides, I will walk you through the reasons. This growth is despite having two impacts, which I'll explain in detail later, but we had an impact in our property business because of launching a new project, Viman. So there was an asset write-off because we used existing land and that had a building on it. So that had about a 640 million impact in this quarter. And the financial services business in insurance, we had an impact coming through the timing of the surplus recognition, which I'll show you when we cover the financial sector slides. So despite those two amounting to over 1 billion, we still saw the Q4 performance very strong at around 14 billion for the quarter, which is a 20% growth, as I mentioned. If you look at the quarterly performance over the last 5 quarters, you can see the absolute performance at close to 14 billion in Q4 this year is in line or higher than what we did in Q3. If you look at the numbers through Q1 through to Q4, you can see the first half performance as the economy was a little sluggish and was starting to show signs of recovery, but not really picking up. You can see the impact we saw in the first 2 quarters, but as we got into Q3 and Q4, you can see the performance has ramped up. Of course, there is a certain element of seasonality that you see in some businesses like leisure, which is there, but even eliminating that impact, notwithstanding that, you can see from last year to this year how the performance has been. If you look at the exchange rate, you can see on the screen at the bottom, the rupee was at 355. That's the average rate for the quarter. And if you look at the average rate for the most recent quarter, it's at around 313, which is around a 12% appreciation of the rupee. So that also does impact some of our dollar-denominated businesses like transportation and leisure negatively. So despite that appreciation impact, we've still seen this performance. In terms of the annual performance, we saw a slight decline in our recurring EBITDA, declining by around 4% to around 43.8 billion from the 45.7 billion that we saw in the previous year. This was largely in line with the expectation, as we mentioned before, that this was a sort of year of consolidation. We did see a normalization in the transportation business, as you can see on the screen. So from about 12 billion of EBITDA, it declined, but that decline, as we've said repeatedly over the few quarters before, is also because we had an exceptional performance in 22-23 on account of the exchange rate being higher, but also high bunkering fuel prices as well as margins as well throughout the year, particularly in the first half of the previous year. So despite that, we maintained that performance. And if you look at the annual recurring EBITDA performance over the last 4 years, from of course the pandemic affected base, we have adjusted upwards and come to this level for this current year. I don't intend to spend too much time on this slide, but just to highlight the movement of finance costs. It's something we've spoken about over the last couple of quarters. As of course, as you can see right at the bottom of your screen, the finance cost, the average prime lending rate in the country has now come down. This is the average for the quarter, from around 25% in the last quarter to around 11.5% in this quarter. So significant decline in the rupee interest rates, which has sort of helped, and you've seen a slight reduction in our overall finance cost. We had an exchange gain on the loan at Waterfront or City of Dreams in that complex because of the move to rupee functional currency, as we've explained before. So we've adjusted that and normalized it. So when you look at the leisure number here, it shows as a negative finance cost, but that's largely because of that exchange gain. But if you eliminate that, the leisure real finance cost or interest cost has actually marginally declined. The recurring PBT for the year, we've seen this is for the quarter. We've seen a improvement over last year, driven by the performance at an EBITDA level. I already spoke of the growth, and we've just normalized the exchange impacts just to show you X of that, what the impact is, and we see a growth in the recurring PBT for the quarter. But for the year, it's a slight decline in line with the EBITDA that I spoke to you about before. We've seen that translate to a slight decline, but again, there were some significant exchange gains last year. So we've just normalized that to show you X of all this, what the PPD performance for the year was. Just moving on to the balance sheet, we've seen our debt levels decline from what we saw in 31st December and against even last year, if you look at 31st March 2023. This decline is largely due to the appreciation of the rupee, so the translation impact on the dollar denominated debt, but also we've held some of our dollar cash as part of our funding strategy. So our net debt has also still declined marginally. Overall, our net debt to equity levels are quite healthy. It's been at that sort of mid-30 levels, so at 31%, and our net debt to recurring EBITDA is still at very healthy levels at below 3% at 2.7%. In terms of some of our ESG initiatives, the group undertook an exercise to further strengthen our ESG framework, to look at that roadmap. We had targets earlier, but we've looked at resetting our targets and looking at those ambitions over the next 5 years and how that flows down to each of our businesses. So that is an exercise we have done. On the right hand of the screen, you'll see some of the focus areas of our CSR, as well as the impacts in terms of number of persons benefited across all the different focus areas that we have. We started off a couple of years ago with an ambition or target of achieving 40% of participation, female participation in our workforce. We are right now trending at around 33%, and we've done a lot of the groundwork in terms of what needs to be done to develop the pipeline, the leadership, and so on. And that's something we continue to focus on, though the target for next year at 40, we may not necessarily hit that given that we're at 33, but we're doing all our efforts to work towards that target. But like I said, we've done a lot of the groundwork and the foundation to be able to continue towards that number. Moving on to the businesses and the update in terms of our transportation business, the Port of Colombo saw strong volume growth, as you can see in this chart, and I'll move on to the numbers later. Krishan already touched on the West Container Terminal. The image on the screen that you see shows the type of progress that we've made with all the reclamation works complete, the key wall construction being done, and now equipment will start coming in around August and will get installed and commissioned for us to be in a position to start operations in the early part of the next calendar year, 2025. In terms of the numbers, SAGT saw transshipment volumes growing quite significantly, so from about 408,000 TEU last year in Q4 to 460,000. So the crisis, the Red Sea crisis has helped and supported this number as well. But overall, we've seen, with the India trade volumes as well, that this number has been quite strong. So this, the overall profitability of the transportation business grew, driven by both SAGT as well as the performance of our bunkering business. So if you look at the numbers on the screen, you see transshipment volumes at 460, or overall volumes, and that's despite the domestic contribution being only at around 10%. So the transshipment growth has more than compensated for the reduction in the domestic volumes over the last year or so. In our bunkering business, we saw extremely strong volume growth of around 50% plus, also supported by the Red Sea crisis, given that ships are now coming around the Cape, and as a result, we've seen growth in our bunker volumes, as well as margins have anyway increased compared to what we saw. So the combination of that meant that the transportation business had a very strong quarter. Looking at our consumer foods business, if you look at Q4, very strong volume growth. So ice creams grew at 24%, and our soft drinks business grew at 42%. Those are the two main significant businesses, and our convenience food business also, after declining for the last couple of quarters, saw very strong growth. Notably, you can see the EBITDA numbers have really rebounded. So an absolute EBITDA at 2.1 billion, up from around 500 million last year, which of course was a low base. But if you recall our conversations in terms of margins, where our margins really hit a low of around 7%, and from that progressively we've seen margins continuously on the upward trend, and the margin at 22% for this quarter is very healthy. I will talk you through a little bit more in terms of our volumes and margins over the next couple of slides. But before I get there, I'd like to just talk to you about the annual performance. So the ice creams business grew marginally by 2%, and beverages grew by 10%, and mainly driven by, as I said before, the momentum that we've seen in Q3 and Q4, which has been strong. Apart from that, we also entered into a partnership with the Reliance Group to market our soft drinks in India, so where we will be sending them concentrate and they will be doing the manufacturing and distribution. So it's early days in that partnership, but it gives us an ability to enter a market like India, which obviously has significant potential. We also expanded our capacity with the acquisition of a bottling and canning plant. We've started production of cans, and we've launched, I think, 6 flavors in the canning range, which actually gives us access or entry into a new market segment, whilst also giving us a little bit of extra PET capacity. If you look at the margins over the last maybe 5 years, you can see the numbers from FY18. This is of course pre-pandemic and all the disruptions that we've had in the country. And despite all the different negative impacts that we've had on margins for the last year or two, and I won't go through that list that's there, and most of you will know the type of negative impacts we've had on cost structures, input costs, and so on, which is why we saw margins decline steadily over time. But from Q3, as you saw on the slide before, you've seen margins increase. And I think the takeaway here is that if you look at the Q4 margin at around 22%, it's actually in line or better, in fact, than what we saw in FY18-19, where it was around the 20% levels. So I think we've seen that recovery in margins, and of course, margins are a function of volume as well, so it depends on how volumes continue to trend. But I think we've seen that sort of recovery, and hopefully from this point onwards, we can see margins at these levels like we've seen before. If you look at the two charts on the top, one is on CSD, the one on the left. We've indexed these volumes just to show you again, whilst we can show a growth of 42% in volumes, it's also important to see that in absolute terms, if you just look at it across, other than in 21-22, where we had these other disruptions due to the pandemic and there were periods of shutdown, and then, when things open up, there was a demand, that sort of pent-up demand that caught up. But apart from that, if you look at it right across, you can see that the Q4 volumes are actually at the highest levels that we've seen from 2017-18. If you look at ice creams, which is on the right-hand side of the chart, again, you see that impact of the Q4 volumes. So with the type of momentum we are seeing, it was of course supported by some favorable weather because of the heat conditions in the country. But I think with the pickup in the economy and consumer discretionary spend, we are seeing that momentum, which should continue. Moving on to our supermarkets business, our retail business again showed strong same-store sales, double-digit growth of close to 11%. As we've seen over the last couple of quarters, that same-store sales number is driven by footfall growth. If you look at the slide, you see over the last three quarters, including this ABV, the basket values have actually declined and the growth has been driven by footfall. I will get into a further discussion or analysis on what's driving that. But on a further positive side, if you look at our overall recurring EBITDA, we've seen growth. The number here is for the total retail business, but if you look at supermarkets, you'll see Q4 numbers at 2.1 billion from around 2 billion. So growth in absolute EBITDA, and that's despite a revenue drop. And that revenue drop, if you look at it from Q3 to Q4 in terms of just quarter-to-quarter momentum, Q3 of course is a seasonal quarter, and therefore it's a peak. So it's not really a drop, it's more just the seasonality. But if you look at it over Q4 last year, it's around a 10% growth in revenue, and that growth has translated to EBITDA. Krishan spoke earlier of the electricity cost increases that we had. He also spoke of the more recent decline, but net we've seen electricity prices being revised around thrice. So the decline still leaves electricity cost still much higher than it was around a year ago. So despite that impact, I think the margin, how it's trending, is a very positive and encouraging sign. We've seen the Q4 margins at 7.9% against 7.7 last year, and 6.9 run rate that we've seen in Q3, which shows how significant in a way the recovery of margins has been in the business. If you look at the annualized numbers, we've seen similar to what we showed earlier. It's a 12% same-store sales growth, really driven by footfall, and ABV has been largely flat. The recurring margins for the year is lower than last year. If I take you back to the previous slide, and that's largely because if you look at the first half of the year, the margins were lower, and then the second half you can see how it's picked up. So with that momentum increase, these margins should sustain at the type of run rates we are seeing. Just like to illustrate the point we made about electricity and how significant it has been. So if you look at the chart, the bars show you the EBITDA in absolute terms, and the line chart, the worm chart here you see is how electricity costs have actually increased quite significantly. So the margin, the EBITDA performance in absolute terms is at these levels despite seeing electricity go up from here, which is almost a doubling of the cost. If you look at the chart below, just in terms of percentage terms, electricity costs in Q1 in 22-23 was at around 1.8% of revenue, and now it has increased to 3.4% of revenue. So it's about almost double, about a 1.6 percentage point increase in electricity. And despite that impact, you can see what's happened with margins, where margins have moved from 7.6 to 7.9%. So despite such a significant electricity impact, I think we've done well in terms of all the other initiatives driving revenue and footfall, as well as other cost management activities that has really translated to this level of EBITDA margins. In terms of a decomposition of the same-store sales, like I said before, it's driven by footfall. If you look at ABV for the quarter was down 3%, and that is despite having positive inflation of around 2.5%. So the weight of purchase or number of units that are in a basket continues to decline, but the trend of that is getting better. So it's still a negative number, which is why the positive inflation of 2.5 is still more than offset by the number of units, which is why we have a negative ABV, but it is getting better. So if you look at the forward momentum and with the recovery of the economy, we should start seeing ABV getting into positive territory. And if we maintain the footfall growth momentum that we are seeing, that should be very positive for overall same-store sales. In terms of tourism, we've seen the momentum, we've seen the increase and recovery. We are tracking at around 85% of pre-pandemic arrivals. So we are still not fully back on track in Sri Lanka, but the momentum is still quite strong. And we expect the trend to sort of continue to get better. The flight frequencies and connectivity into the country continues to improve. And with that, we should hopefully start seeing the tourism numbers get back to normal. In the Maldives, it's a very positive trend. Overall numbers have been much better than 2019 as well, pre-pandemic numbers. And we'll talk you through some of the numbers. So overall for Q4, we've seen in Colombo, the occupancy is slightly better. ARRs have been much better, and that's translated to better EBITDA margins. In Sri Lanka as well, Q4, of course, is a seasonal quarter, but we're comparing last year Q4 to this year Q4. A strong increase in ARRs. So the yield management strategy has sort of worked, and we've been able to get our margins up to around 35%. And it's a similar story in the Maldives, where margins have been quite strong. We've had our challenges with some of the cost increases, but that's also started normalizing, particularly in the Maldives, with fuel costs coming down. So the overall recurring EBITDA performance for Q4 was quite strong. We do have the ramp-up costs associated with the City of Dreams now coming in, but even if we normalize for that, we've still seen close to a 40% growth in the earnings or EBITDA for the quarter. This shows you the annual performance, so continued increase in ARRs right across all three segments. Moving on to City of Dreams, this is just an image of it's an actual image, it's not an artist's impression. You can see the City of Dreams branding on this image. The branding itself may not necessarily sit right there. It's just to illustrate how this would could look. I won't go through the chart on the right, which shows it's an illustration of all the different components of the property, which you already know. But just to highlight, so within this entirety, the City of Dreams complex here, apart from the three towers, we've got the 687-room Cinnamon Life Hotel, which will sit within the City of Dreams complex, which will be managed by Cinnamon Hotels and Resorts. We have the banqueting and conferencing facilities. And then we have at the top floors, the five topmost floors in the building will be managed by Melco under one of their ultra high-end brands, Nua. In terms of the timing for this, as we've said before, we are looking to open the Cinnamon Life Hotel and the related aspects of the hotel in around Q3 of 24-25, and then phase 2, which will be the gaming space, Nua, and the retail mall around mid-2025. The announcement that we made on the 30th of April was essentially what's on the screen, but I'll just give you a quick rundown of the key components. Melco will be operating the gaming facility and investing $125 million in the fit out and equipping of that space. They've also got a 20-year license from the government of Sri Lanka to operate at the property or address of this complex. And as part of this arrangement, as we said before, the Cinnamon Life Integrated Resort has now been rebranded as City of Dreams Sri Lanka. And Melco will manage the 113 keys under NUA. As we've always said, we are in terms of gaming, it was always a question of JKH or Waterfront acting in the role of a landlord. So if you look at the bottom of the screen, our role will be as landlord, where we will be renting out around 180,000 square feet of space. And in return, we will be getting a fixed rental and a variable rental that's linked to EBITDA. And with the NUA property, we will be the asset owner once again, and it will be a typical hotel management contract that will be in place where Melco will run the property. Just moving on to a couple of slides, which I'm mindful of time. I will run through these quickly, and maybe we could deal with some of these during the question and answer session. So the IR that we have here will be the only integrated resort for the whole of South Asia. So there are obviously a couple of others in East Asia, but if you look at South Asia, there's nothing. And obviously from a tourism standpoint, Sri Lanka will rely on Indian tourism, and that's again because of the proximity and connectivity that will drive tourism numbers into the country. And for City of Dreams, it will be not just India, but the whole regional market that we could tap into. In terms of Melco's other integrated resorts, I'm sure most of you know this, but just to give you a snapshot of the different properties that they have all over the world, a couple of properties in Macau, but in the Mediterranean and Manila. I think if you look at the square footage, the gross square footage of these integrated resorts, City of Dreams Sri Lanka, our property at 4.5 million square feet, is really not insignificant. Of course, you've got the two large properties in Macau at 7.5 million roughly, but still the City of Dreams complex in Sri Lanka is also a very significant property. Just in terms of what IRs have done for tourism in some other markets, we all know what happened in Singapore with the opening of the two IRs. So if you look at the chart here, you'll see that Singapore was at around 10 million tourists pre-opening of the IRs. And that's obviously a significant base. But despite that significant base, you can see once the IRs opened, how the numbers have sort of grown quite exponentially. Right? It's doubled over that period up to, of course, the onset of the pandemic. If you look at Macau, of course, there's a multiple number of IRs that have opened, but still they've maintained that momentum, and it's a similar story with Vietnam. Just in terms of illustrating the type of casino revenue that some of the properties we've listed here have done. So if you look at Marina Bay Sands, you can see their numbers have recovered actually beyond what they did pre-pandemic. If you look at the Solaya Resort in the Philippines, their first full year GGR was around 680 million, and the peak GGR or casino revenue in Naga World in Cambodia was at around 1.7 billion. Now, of course, these properties are very different in terms of IRs. The markets are different, and the timing is, of course, different. But whilst this is not to give you any form of guidance, it's just to give context to what IRs have done in the rest of the region and what potential we could have for an IR in Sri Lanka. In terms of the spillover benefits, the two charts on the right-hand side show what type of spillover benefit we saw with Marina Bay Sands. And also, like I said earlier, in a market like Singapore, where it was already at such a high base, you still saw the needle was moved quite significantly in terms of the IR impact on overall tourism numbers, overall hotel rates, employment, and impact to the economy. So in a smaller market like Sri Lanka, where we are still only at about 2 million arrivals, I think the transformational impact can be that much more significant. We've also spoken in the past about the MICE, the conferencing market. I'll just move on to our property business. With City of Dreams now, or Cinnamon Life, we've now see a lot more traction in terms of the number of sales inquiries and the leads that we have. A lot more interest over the last quarter or so with interest rates coming down and the project getting to completion. We've made good progress with Tizen and Viman as well, which is the new development, which is listed here, which we had spoken about, which is a suburban property development. Lastly, on our financial services business, we've seen strong growth in both our insurance business and the banking business. As I mentioned at the outset, the Q4 performance on the face of it is marginally down, but that is really because of our insurance business, where it's a timing difference in the recognition of our surplus. So if you look at it, in Q3, we had a recognition of 2.8 billion, but last year we recognized part of the surplus in Q3, but there was a spillover of about 500 million in Q4, whereas this year we recognized it all in Q3. So whilst that supported the Q3 performance, when you look at it in Q4, this 500 million needs to be adjusted there. So despite that, we've been flat and driven mainly by the banking business, which has shown healthy profit growth, loan growth, as well as a reduction in the stage 3 loan, the ratio, which is a very positive trend. So that brings us to a conclusion on the presentation. I'd like to open up the floor for questions. Just to remind you once again, if you have any questions, to please pose it on the Q&A tab at the bottom of your screens. Krishan, maybe I'll start with a couple of questions on leisure. Yes. There's a question on the city hotels performance, that it's not as good as the performance of the resorts in Sri Lanka. Maybe if you could just elaborate on that.
Yes, the city hotels occupancy overall during the peak season, December to March, was about 70%, but there was an impact from the new supply that has come over the last 2 years. So if you compare it to the 2018-19 period, apart from the fact that during this season overall arrivals were about 15% less than that peak, there is a new supply of additional rooms in the city, significant additional supply since pre-COVID. So that is why you're seeing the performance not being as good as the performance of the resorts. But of course, we expect that arrivals to the country and to the city will continue to grow, and that these rooms will get absorbed.
Any update, Krishan, on the new hotel in Kandy? And a follow-up to that same question is that whether there's a property development element in the surrounding region. I think that might be linked more to our Rajavella, the Victoria Golf Course property. Maybe if you could elaborate on that.
The hotel in Kandy is expected to be operational towards the end of the current calendar year. We expect to open in time for the season. In terms of property development, nothing else is planned outside Colombo. We are not planning our own development in the Victoria Golf Course near Kandy, but we will continue to develop the land bank there and look at selling land to potential landowners.
There's a question on whether any price adjustments on frozen confectionery. As we've said before, we have repeatedly sort of adjusted prices over the last couple of quarters, and I think we spoke quite extensively in terms of where we are with the margins. So I think as we see volumes recover and as long as there are no input cost shocks, I don't think we anticipate or expect to undertake any price adjustments any further. But as we've said before, we are quite conscious that we want to maintain our margins. As you saw, the margin recovery has been quite strong. I think we covered this, but just to reiterate the point, the currency appreciation, yes, it does have an impact and did have an impact on our hotels. So the translation impact of even the Maldivian performance into rupees, as well as the dollar revenue on some of the other local properties, does have an impact. So the Q4 performance is despite seeing that around 12% appreciation that I referred to before. There's a question on the BYD dealership when it becomes active and the long-term plans for the business. Krishan, if I could ask you to.
No, we will be ready with a showroom quite soon. It really depends on when the authorities open the country for new vehicle imports. So in the interim, we may see some sales because the tourism sector has now got approval to import a certain number of new vehicles. So that is an opportunity in the interim, but we are ready. So it really depends on when the country is opened up for vehicle imports. And the long-term plan, we see tremendous potential to grow the business. We think that the transition from the internal combustion engine vehicles to electric vehicles will happen at quite a rapid pace over the next few years. And BYD being, at the moment, being the leading electric vehicle company in the world, is well positioned to play an important role in that. There are no specific plans at this point for assembling vehicles in Sri Lanka, but in terms of demand for the vehicles, we think it will keep growing over the years.
Thanks, Krishan. A couple of questions on the minimum room rates.
Yes.
And what the sort of impacts of it going forward will be on the performance of the city hotels.
Yeah, and the minimum room rates, it has been announced that they would be lifted from the end of this month. In any case, yesterday there was a decision at the Court of Appeal to suspend the minimum room rates. And given that the authorities have announced that they will withdraw the gazette or rescind the gazette and remove the minimum room rates, we expect that beyond this month that it will not be in place.
Thanks. There are a couple of questions that I'll try and sort of combine and address, which is relating to the City of Dreams, about future rent. So as we clarified earlier, the rent from the or the income to the project from the gaming space will be a rental, that is a fixed rental and a variable rental, and the variable component will be linked to EBITDA. So the combined totality of that will be the share of rent that we get from the project. There's also a question in terms of the pricing of the Cinnamon Life Hotel, at what price point we'll be offering our inventory. That of course will depend on where the market itself is. It's not something that will be controlled by our partner Melco. They'll be operating the 113 rooms, and of course there'll be a joint effort obviously in terms of driving volume, looking at the type of activities that one needs to look at, because it's ultimately an integrated resort. So the type of activation plans, the marketing plans that you have, whether it's driving conference traffic, wedding traffic, normal hotel traffic, or gaming traffic, will need to be something that's worked together. But in that context, obviously, we will be selling rooms to all types of clients and customers, whether it's business, leisure, or otherwise. So the pricing will be based on market and our expectations, but naturally we'll have to work together in partnership in terms of how we look at it, because it's ultimately from a customer perspective an integrated resort. There's a question, Krishan, on the bunkering market in terms of market size and anything that we expect to do in Hambantota.
In terms of Hambantota, Sinopec is now supplying fuel to bunker providers, and we are procuring some of our quantities from the Hambantota facility of Sinopec. Volumes in the Colombo and has increased significantly with the Red Sea issues. Over 50% growth in volumes we've seen since January, and we expect that trend to continue. So overall, the business is seeing better volumes.
Thank you. There's a question on the total earnings for Cinnamon Life would be recorded under property. or will the hotel revenue be recorded separately? I think we moved the entirety of the cinnamon life on our City of Dreams in under leisure. So the components that remain within property would be just the one-off, the non-recurring components where once we sell off the apartments and that part of it will sit there. But the hotel, all the rental aspects of the mall, all that will now sit within the leisure business, given that it's ultimately operations of an integrated resort. There's a question on the retail outlets in terms of our plan on capex and whether we plan to accelerate the outlet opening. As we've said over the last sort of maybe year or two, given the economic and financial crisis, we had sort of slowed down. We didn't stop the rollout of outlets, but now given the environment, the stabilization of costs, as well as the market outlook, we will look to expand or roll it out. But even last year, though we opened one, there were already a few outlets already in the construction pipeline. So yes, it is something we will continue to roll out, and you can see the type of momentum we are seeing, where the business is seeing that continued growth in footfall, which means it's a combination of growth of modern trade share. As we said before, the modern trade share itself is still at very low levels. The penetration or density of outlets in the country is still something that can expand. So the long-term prospects are still very much there. So we will continue to expand our footprint. There's a question, Krishan, about our land bank in Jaila. Apart from where Viman is, we also have further land there, and whether we expect more Viman-esque developments in the surrounding area.
Yes, very much. Given the very good initial success of Viman, it looks like it's a model that we can continue to develop. So given the land bank we have in another location in Jaila, we will look at developing that as well once we've completed Viman to some extent. But with this model, we expect that not just the land we own in Jaila, but in other suburban locations as well, we would look to develop more Viman-like projects.
There were a couple of questions on the partnership with Reliance. And just to elaborate on that, like I said, it's early days. So what we're doing initially is looking at certain flavors and looking at sending the concentrate, which will then be manufactured, packaged, and then distributed by our partner in India. Obviously, it's a very powerful organization, reputed organization, and with the type of strength and distribution they have. Of course, we've done studies on the flavor profiles, and we believe that the flavor profiles that we have with some of our portfolio is something that is very similar to the wants and of the Indian market, particularly in the southern part of India. But it's early days. Now we are in the process of getting the product out there, and depending on the traction, the acceptance of the product, then it will be scaled up further in terms of rolling out distribution as well as adding on other flavors. So from our perspective, it will be a royalty income that we get, and in terms of also then selling the concentrate, which of course, I mean, we all know the size of the Indian market will be many, many fold of what Sri Lanka is. And though we won't be recognizing the gross revenue of a sale and the profitability, but in terms of the volumes, this would, I mean, if it does take off, it could be that very much more significant than what's in Sri Lanka. But it is early days, so we will have to look at taking it a step at a time and hopefully growing that business. There's a question on, Krishan, the benefit we saw from the Red Sea crisis, which we did speak of. And of course, it's difficult to speculate whether that will continue or not. But there's also a question relating to that about change in the demand conditions in terms of underlying demand apart from that, and how we see that going forward.
Yeah, I think at SAGT in the last few months, we've seen an increase in volume because of the Red Sea situation, not only at SAGT, at the port of Colombo, increase in overall transshipment volumes. But where we expect to see a trend is that with exports now picking up, and also with economic activity generally picking up, and the likelihood of imports also picking up, we expect that domestic component at the port to increase. So from what was for a long time around 18 to 20% of total volume being domestic, we've seen that component come down quite significantly. But we expect that there will be some recovery in that, with exports and imports expected to pick up over the next few months.
On the bank ownership, Krishan, there's a question in terms of NTB about whether there will be any, that the governor has mentioned that there are no new exceptions to the bank ownership, but there's a framework around that and how we plan to just deal with that.
No, we will, I mean, we are expected to reduce our shareholding in the bank, and we will reduce it in keeping with that. It's just that we've run into so many issues with COVID and the economic crisis and a very depressed market. So divesting the shares has been a challenge, and the valuations are not ideal at all. But we will reduce our shareholding at the right time in keeping with the regulatory requirement.
There's a question on expectations of occupancy once we commence City of Dreams. I think whilst there'll obviously be a ramp-up period, if you look at overall, as we've said before, City of Dreams itself will be a catalyst to create demand into Colombo and to Sri Lanka. So apart from the, we have multiple banqueting conferencing facilities that can cater to almost 5,000 people. So the conferencing, the weddings, proximity to the Indian market, and of course then gaming. So if you look at it in terms of, I spoke of how other markets, like even mature markets in terms of tourism, like Singapore, saw the needle being moved in terms of overall impact on tourist arrivals with the IRs. So I think Colombo can certainly, or Sri Lanka can certainly have that sort of impact. And if you see that impact coming through, then essentially, we will see not just Cinnamon Life, but the whole of Colombo seeing a lot more occupancy, which will then drive both occupancy and rates. But that will be the sort of ramp-up period that we need to allow for that. And that's where we believe it can be transformational, not just for our project, but even the country. Will the supermarket business, Krishan, look for any inorganic growth given the stress on some of the other players? Anything we can comment on? Obviously, we've seen the organic growth path being very strong, but anything we can comment on that?
Nothing specific that we can comment on. We are open to any opportunities if there was one at the that makes sense. So there's nothing specific.
And just to add to that, I think in terms of the success of our supermarket business has been the sort of format, the type of branding efforts that we've done, the consistency in terms of delivery. So ultimately, we'll have to look at it in that context as well, even if we were to consider something, because we have been successful in terms of being ranked the #1 supermarket brand, despite being relatively small, or being the second largest player. And I think part of that is also given due to the consistency we've maintained in terms of the offering and the customer experience itself. There's a question again, Krishan, on BYD, whether JKH can market other vehicles, and if we can market other brands, any plans on a rollout. And on this one, of course, I can take it, whether this segment will be a separate business or under retail. I think we had mentioned it before that it will sit within our retail industry group and reported under that when we commence operations. But Krishan, maybe on the first part of the question, if you could answer.
No, we don't intend to get into any other vehicle brands at this stage. It's a new business for us, and we believe that focusing on just the BYD brand has enough potential and should have enough volume without having to look at other brands. So right now, there is no plan at all for any other brands.
There's a question on what will happen to Crescat, and that it's still very well located. We just did a refurbishment there anyway, so if I can maybe ask you to...
What's happened with the opening of one or two of the other malls, of course there is a fall in footfall, but with the refurbishment, we have seen an improvement. We are looking at the tenant mix and looking at various activations, and we believe that with time that the footfall will return as mall shopping we expect will continue to grow. And given the location, as occupancy at the hotel also improves, we expect that footfall to Crescat will grow. So at the moment there isn't a plan to do anything else with that building. We'll continue to operate it as a mall.
There's a question on how much of our debts, whether we've converted all our dollar debt into LKR, if not how much remains in FX, and the repayment schedule. So essentially what we did with the Cinnamon Life loan was that, as we've explained before, as we get into operations, the functional currency of that entity moved from dollars to rupees. So the dollar loan still is a dollar loan. It's just that now it gets translated into a rupee value, whereas earlier both the asset and liability were in dollar terms. So there was that hedge. So by moving Waterfront Properties, which is the project company, into a rupee functional currency, you see that impact. The other large loan in the group is the IFC loan, which is at the holdco, the $175 million of loan. But there we have a natural hedge at this moment of time because we are still holding some of our cash in dollars. So it's a fully hedged position that we are maintaining at this moment of time. In terms of the loan at Waterfront Properties, it's heavily back-ended. It's due for repayment in December 2026. And about 75% of that loan actually is meant to be paid as a bullet repayment in December 2026. So the rest of the loan, the capital repayments actually gradually ramp up. So as I said, it's quite heavily back-ended. There are two questions on the interest expense on the Cinnamon Life loan. So right now, the way we've treated this is in line with the accounting standards. It gets capitalized into the project cost, given that it's a project in construction. So once the project becomes operational, and of course there are the different components, then the ability to capitalize those components will cease, and then that will come into the P&L, but that will be with the start of the operations as well. We may have touched on this. I think indirectly we already spoke of the benefit to the rest of the city, how the needle can move on tourism. So there's a question in terms of what would be the impact on Cinnamon Grand and Cinnamon Lakeside once we open Cinnamon Life. Of course, in the short term, yes, it's an increase in inventory, but overall, as we said, with the type of catalyst this can be, then we expect overall arrivals to actually increase, and that will have a spillover benefits, not just for our other properties, but for the entirety of the city as well. Staying with Cinnamon Life, there's a question on both subsidiaries, that Ceylon Cold Stores and John Keel's PLC, which are listed, have stakes in Cinnamon Life, and it's a component of their balance sheet, and what will happen to these stakes over time. As we've said before, this is sort of coming from the legacy issue of these two entities owning the land, and we consolidated all the land into this 10-acre contiguous block that enabled us to do this development. So it was really a question of then not just the valuation of the land, but the valuation of the project or expectations of how this could be transformational. So whilst that option of cleaning it up or buying it out was there right at the outset, given that there are minority shareholders, we felt it was better to keep it so that then the full value translation or realization of the full value of that land into the project would benefit all shareholders, including minority shareholders. So it's something we'll need to monitor and see what is best from their perspective. From a John Keel's perspective, it's effectively still owned there, but I think it's more a question of how one would look at it from what is the best valuation or outlook from a minority shareholder standpoint. I think we've covered most, if not, I think all of the questions that we have been presented with. So I'd like to conclude today's proceedings. Thank you, Krishan, and thank you to everyone for joining us this evening. The presentation will be posted on our website shortly, so you will be able to see a recording of today's webinar. Thank you once again for joining us.
Thank you.
Have a good day.